All right, hello everyone. I think we should slowly get started. So, welcome back to session 2 of the NATUREFIN expert webinar, Private Capital Mobilization for Investable Projects. Thank you again for joining us today. Now, yesterday, session 1 focused on the investment gap. So, the main barriers to private capital, bankability, and what investors look for. And today we will move more directly into the municipal perspective. So where municipalities can start, which tools are available, and how an actionable roadmap can be created. As a reminder, the session is being recorded, so attendee microphones and cameras are also disabled. Please submit your questions through the Microsoft Teams Q&A panel at the end of the session. The organizing team will monitor the questions and bring selected questions to the speaker during the Q&A section. We are pleased to welcome back Matyas Horak, CFA FRM, Senior Sustainable Investment Specialist, for the second part of this webinar. Matyas has around 20 years of experience across credit, project finance, ESG, and sustainability integration, spanning multi-asset portfolios for financial institutions. He has led sustainable investing at Legal & General, developing sustainable investment strategies across public and private markets, and led ESG analytics and banking and corporate credit at Santander, Royal DSM, MBH Bank, and Raiffeisen Bank, giving him deep structuring, restructuring, and risk management expertise across emerging and developed markets. Matyas, thank you again for joining us today, and the floor is yours.
Thank you very much. I hope you can hear me well, and thank you for the reintroduction again, and a warm welcome from me for those who might have not been able to attend yesterday's session, and welcome back for the others. So we'll kick off. So as mentioned in the first session, I tried to build the conceptual foundation, why private capital is hard to attract for nature, what bankability means, revenue models and levers for making projects bankable, as well as some common pitfalls of nature projects. And we also looked at how investors think and how regulation is reshaping the investment landscape and how is it driving demand. And in today's session, I would like to move from concepts more to action a little bit. The question I'm trying to answer is, given all of that context, what could a municipality or a region actually do? What tools do you have? What has worked elsewhere? And what could you do specifically, maybe as one of the 6 partner organizations in NATUREFIN or as another EU municipality prioritize in the next, let's say, 1-2 years. So I will cover new and expected regulations that shape and can drive the comprehensive set of instruments and mechanisms that local governments can deploy to mobilize capital, a sort of municipal toolbox for nature finance that could improve bankability, de-risk investments, and reach scale. And I would spend some time to look at how municipalities could influence and shape the enabling policy environment, both locally and through advocacy at national and EU level. I'll look at some real project cases from Europe and beyond, inserted after the relevant sections. And then I would try to extract the common success factors into hopefully a more practical framework that maybe you could apply directly to your own area. In terms of the examples, I just wanted to mention that, of course, I'm not familiar with all of the potential examples or case studies that could be beneficial. So I try to use some of those from beyond Europe, especially that I came across not directly, but through my work through different publications, and I found relevant, potentially could steer maybe some ideas and pick some of the interest of yours. So let's jump in. So where do municipalities start? So transitioning from the conceptual framework of barriers and levers to the practical starting point, But before we talk about what municipalities can do, maybe it's worth taking a stock where they already are. So the good news is that most EU municipalities are not starting from zero on nature policy. There is already a substantial body of EU legislation that creates direct obligations and responsibilities for local and regional governments in relation to nature. Understanding this baseline is important because it tells you where the demand for nature projects already exists, even before you create new policy frameworks. So Natura 2000 is, of course, the flagship nature protection network, covering roughly 20% maybe of the EU's land area and 10% of its seas. It comprises special areas of conservation under the Habitats Directive and special protection areas under the Birds Directive. Member states, and through them, local and regional governments are responsible for the designation, management, and monitoring of Natura 2000 sites. And most of the partners in this program, we assume, will have Natura 2000 sites within or adjacent to their territories, and they have legal obligations to maintain or improve the conservation status of those sites. The Water Framework Directive, I think I mentioned yesterday, requires all water bodies to reach good ecological status. Achieving this typically requires action at the catchment level, including restoration of riparian habitats, reduction of diffuse pollution from agriculture, and improvement of river connectivity. These are exactly the types of projects that could attract maybe nature-based finance if they are properly structured. Now, the Floods Directive requires municipalities to produce flood risk maps and management plans. Nature-based solutions are increasingly recognized as cost-effective ways to reduce flood risk and can be integrated into flood management plans in a way that creates investable projects. So adding to these existing frameworks, the EU Nature Restoration Law, which adopted in 2024, sets binding restoration targets. I have a extra slide on this coming up. While the targets are set at national level, the delivery will largely happen at local and regional level. So this is a major new driver of demand for nature restoration projects and therefore for nature finance. The partners in this program, I think the key takeaway is that the legal mandate for nature protection and restoration already exists. So you're not operating a policy vacuum. What is often missing is, of course, more the financing mechanism to deliver on these. So the EU Nature Restoration Law, what it means for local governments, I guess it's one of the most significant pieces of legislation, maybe in a generation, and has direct consequences for every municipality and region. So the law sets a core binding target. By 2030, the EU must have restoration measures in place for at least 20% of EU land and 20% of EU sea areas. By 2050, restoration measures must cover all degraded ecosystems that need to be restored. For local government specifically, the law includes several concrete obligations. Member states must halt the net loss of urban green infrastructure by 2030 and then progressively increase it. They also must restore at least 30% of riparian habitat by 2030 and 60% by 2040. They also must work towards restoring drained peatlands used for agriculture. And they must ensure rivers are returned to more natural flow regimes. So these targets that member states must incorporate into their national restoration plans. And of course, local governments are the primary delivery agents for many of these measures. Urban green, river restoration, and floodplain management all happen at the municipal and regional level. So why does this matter for nature finance? Of course, because regulatory obligation is one of the most powerful enablers of private investment. When an investor looks at a nature project, one of the biggest concerns is policy risk. The risk that the political environment changes, or the policy environment changes, that the project loses support, and the revenue dries up. A binding EU law removes much of that uncertainty because it signals that this is not a discretionary spending item that can be cut in the next budget cycle, but a legal obligation with consequences for non-compliance. For partner municipalities, I guess the nature restoration law has two practical implications. First, you now have the legal mandate to spend money on restoration. This could be an asset in itself because it can justify maybe budget requests and makes the case for investment in. Second, it raises for an investable pipeline, a project that delivers on the nature restoration law obligations is one that maybe an investor can trust that will not be cancelled. The challenge is that the law's transposition, of course, into national law varies significantly across member states. So some governments might be moving quicker and others might be a bit slower or facing political resistance. But maybe our partners could proactively engage with the national authorities to understand exactly what obligations apply to them and on what timeline. So the EU CRCF, which I also mentioned yesterday, I think a little bit. So two of the most significant market developments shaping EU nature finance is, of course, the CRCF, so the Carbon Removal Certification Framework, and emerging biodiversity credit markets. I think it's maybe the other. Both create new revenue opportunities for municipalities that understand and engage with them early. So the CRCF was adopted in 2024. This is the first EU-wide regulatory framework specifically designed to certify the quality of carbon removals from land-based activities. Before the CRCF, voluntary carbon credits varied enormously in quality, and I guess they still do. Some were credible and science-backed, and others might be a little more than greenwashing, I'd say. The CRCF establishes common methodologies and quality criteria across the EU, which could be a game changer for municipal scale nature projects. So under the CRCF, eligible activities would include things like sustainable forest management, carbon farming in agricultural soils, peatland revetting, and there's also a category called carbon storage in products. These standards require that removals are additional, meaning that they would not have happened without the payment, and that they are monitored, reported, and verified by a third party. For municipalities, as the practical implication is significant. Because if you own forests, peatlands, or wetlands that are sequestering carbon, you may now be able to generate CRCF certified credits in the future and sell them to EU companies that are seeking to meet their voluntary net zero or nature positive commitments. The corporate market for credible EU certified credits is growing, driven in large by also the CSRD that we talked about yesterday, so the Corporate Sustainability Reporting Directive, which requires large companies to disclose and manage their nature and climate impacts. The biodiversity credit markets maybe are somewhat less mature, but they are moving quickly. Here the concept is similar. A company pays for verified additional biodiversity improvement and receives a credit it can use to demonstrate progress against its biodiversity targets. So here the key drivers are the Task Force on Nature-related Financial Disclosures, the TNFD, or things like the Science-Based Targets for Nature Initiative, both of which are pushing companies to set and report on biodiversity commitments. Of course, markets are still evolving, and there is ongoing debate about methodologies, things like permanence, additionality, or what is the risk of greenwashing. And municipalities should probably not build their financial models entirely on credit revenues until these markets are more mature. But they should absolutely be monitoring developments, potentially piloting projects to build experience and ensuring they have the monitoring and data infrastructure needed to participate credibly when markets do scale. So I wanted to take a quick detour. I think I have three smaller case studies. Wanted to introduce quickly, more in detail, the UK Biodiversity Net Gain Scheme, which is maybe one of the clearest examples of how regulation can create a financing mechanism for nature. So the biodiversity net gain in England requires most developments to leave biodiversity in a better state than before, with at least 10% measurable improvement. This does matter financially because it creates something many nature projects usually lack, which is a legally defined buyer. Now, developers have an obligation to secure biodiversity gains, whether it's on-site, off-site, or through another approved route. And that creates a demand for habitat creation, restoration, and management. There are three ways a developer can achieve biodiversity net gain. They can create biodiversity on-site within the red line boundary of a development site. If developers cannot achieve all of their biodiversity net gain on-site, they can deliver through a mixture of on-site and off-site. Developers can either make off-site biodiversity gains on their own land, also outside the development site, or buy off-site biodiversity units on the market. And then if developers cannot achieve on-site or off-site biodiversity net gain, they must buy statutory biodiversity credits from the government. But this should only be a last resort, and the government will use the revenue to invest in habitat creation in England. So, for example, if a developer cuts down some trees on the site because of building a real estate development or having a manufacturing facility, they must make up for this impact on the habitat, as well as delivering 10% biodiversity net gain. They must do a survey of habitat before development and use the statutory biodiversity metric to explore options. This will tell them how to make up for the loss of the trees and what more they need to do to achieve 10% biodiversity net gain. If they cannot achieve the 10% biodiversity net gain by creating and enhancing on-site habitats, they must buy off-site units. And if that is not enough to achieve the biodiversity net gain, they must buy statutory biodiversity credits. So from a finance point of view, this is quite powerful because it transforms biodiversity from something socially desirable into something with a payment logic attached to it. The payer is clear, the obligation is clear, and the transaction can be structured. For municipalities, the lesson is that policy design is not separate from finance design, I guess. If local, national, or EU regulation creates a predictable obligation, then maybe it can also create a predictable revenue stream or market demand. And this is often the missing ingredient in making nature projects financeable. Another example that I found maybe important because it could broaden our understanding of what finance means in nature finance. Sometimes the question is not how to attract commercial capital, maybe, but how to secure reliable, durable funding over the long term for ecologically critical landscapes. So I found that the Prespa Ohrid Nature Trust that was created in 2015 is quite an interesting initiative. It was created to support conservation across a cross-boundary landscape spanning Albania, Greece, and North Macedonia. That in itself is important because many high-value ecosystems do not fit, of course, neatly within one municipal or even one national boundary. PONT, which is short for the trust name, uses its funding to leverage additional capital, which can include mobilizing private investment. As a conservation trust fund, its model is designed not only to distribute its own endowment income, but also to act as a catalyst. And its funding is used to leverage co-financing. So PONT grants often serve as a foundation to attract additional funding from other donors and sources for specific projects. It does leverage political and financial commitments, so it actively engages with governments to leverage further funding and political support for conservation. And it could attract even more additional funding. The long-term stable core funding provided by PONT to protected areas and NGOs has enabled these organizations to secure additional funding for planned projects and activities. So the legal structure is there's a board, 50% conservation and 50% consisting of government and donors. So this would avoid capture. And so this structure matters because it creates permanence and the right governance. So it does provide a vehicle that can receive donor and conservation capital, steward it over time, and then direct it into protected area management and conservation action in a stable and credible way. That's a different problem for project finance, but it is, of course, no less important. So the lesson, I guess, is that some places are better suited to a trust fund or an endowment style model than the project-by-project commercial model. If you are dealing with protected areas or cross-border landscapes or places where revenue generation will always be limited for the longer term, then the right question may be how to create a durable stewardship finance. So if I'm not wrong, that maybe Malik is the Albanian partner of the NATUREFIN project is maybe explicitly mentioned in one of the municipalities involved in a pond financed initiative to develop an action plan for an ecological corridor. And this does demonstrate that Malik is recognized as a stakeholder within Pond's focus region and is engaged in its conservation activities. So since Pond provides grants to municipalities as part of its, I think, environmental actors program, Malik might be eligible to apply for funding for relevant conservation and community projects. The other case I wanted to mention is it's more about scale. This theme runs through, I guess, the whole webinar, that the scale matters and maybe isolated projects are often not enough. So the LIFE program, which I mentioned, is the European Union's funding instrument for green projects that benefit the climate and environment. And these LIFE integrated and strategic nature projects are useful because they are explicitly designed to implement environmental and biodiversity plans at territorial scale and to mobilize additional finance around them. So Spain's LIFE Wetlands was announced, I think, recently in February 26, which is the largest LIFE project in history, with a total budget exceeding 270 million euros. And it aims to restore over 26,000 hectares of wetlands across 107 Natura 2000 sites in all 17 autonomous communities by 2036. I think it does matter, or this example does matter because scale creates visibility and maybe coordination and a stronger case for follow-on funding. What these projects show is that EU program capital can do more than simply fund activities. It can also build territorial platforms, partnerships between levels of government, implementation structures, project pipelines, co-financing logic, and maybe even delivery credibility. So once those things exist, it might become much easier to connect projects to other public blended or private finance sources. So the takeaway, I guess, is that program finance and project finance are not the same thing, but they're both necessary. If you want to mobilize wider capital for nature, one of the smartest moves may be to use e-program instruments first to create the conditions that make later investment possible. Now I would move into what are the tools available for municipalities, with a short intro. So to make it concrete with a stylized example that illustrates the transformation from a grant project to a bankable project. If you imagine a municipality, maybe a river in a river catchment area, they would want to restore a floodplain, rewetting the land, removing drainage infrastructure, and reintroducing native vegetation. The ecological case of this is clear. A restored floodplain will reduce flood risk downstream, improve water quality, maybe sequester carbon, and also support biodiversity. The total project cost would be a few million euros. Now, in the grant model, the project may be funded entirely by a combination of LIFE funding, national environmental grants, and municipal budget. No private capital would be involved. The project happens, the ecological outcomes are delivered, but maybe there is no revenue model, no financial return, and no replicability unless the next round of grants come through. So this is maybe the model of how many nature restoration projects are currently funded. Now, if you imagine a different design for the same project, maybe the project team spends 6 months on a project preparation with support from a technical assistant, perhaps you or by National Development Bank. During the preparation phase, they would do 3 things. First, they would identify the downstream water utility as a direct beneficiary of the catchment restoration. The utility would save money on water treatment because cleaner catchment water requires less treatment. They would negotiate, let's say, a 10-year service agreement under which the utility pays an annual fee for the ecosystem services delivered by the restored floodplain. This becomes the primary revenue stream. Second, they would identify a regional insurance company that offers lower flood insurance premiums to downstream properties after the floodplain is restored. The insurer would agree to make a contribution to the restoration fund in exchange for the risk reduction they would gain. This could become a secondary revenue stream. Now, third, the municipality, if it has the capacity in this case, I would assume it does, provides a 10-year guarantee that it will maintain the restored habitat, giving investors confidence that the ecological outcomes and therefore the service contract payments will be sustained. This would reduce the perceived risk of the project. So with these 3 elements in place, the project can now be presented to investors. A green bond, let's say, would be issued by the municipality or by a special purpose entity backed by the utility service contract and the insurance contribution, and underpinned by the municipal guarantee. So use of proceeds and allocation would be verified also by a third party. So private investors, perhaps a regional development bank or a sustainability-focused credit investor would subscribe to the bond, and the project would be financed. So the ecological outcome is identical to the grant model, of course, but the financing is fundamentally different. Public money would have been used to strategically create the conditions for private investment rather than covering the full cost. And the structure is potentially replicable. Once this template exists, it can be applied to other catchments, other floodplains, or other municipalities. This is what making a project bankable so this is what making a project bankable would look like in practice. It does require some preparation, of course, and expertise, and often some concessional public funding to bridge the gap, but hopefully it is achievable, and it is being done in some forms across Europe right now, I believe. So let's start with the full picture of municipalities could actually do. The tools available to local governments in nature finance, from my perspective, fall into 5 broad categories, and together they constitute a comprehensive toolbox. You would not necessarily maybe use all of them at once. The right combination depends on your context, your project type, and even your starting point. But it is important to see the full picture before deciding where to focus. The first category is pipeline and preparation tools. These are the instruments and the actions that help build a credible investment-ready pipeline of nature projects. They include using EU technical assistance facilities to fund feasibility studies and financial structuring, establishing internal capacity to manage and develop nature finance projects, creating a project registry maybe, or a pipeline database that can be shared with investors, and commissioning independent environmental and financial assessments for potential projects. Without a pipeline, all other tools could be irrelevant. because of course you need projects and solutions to finance before you can finance them. Second category is revenue tools. These are the instruments that create or improve the revenue streams that make projects bankable. We have already discussed the main ones: service agreements, developer contributions, user fees, performance-based contracts, and ecosystem service payments. The third category is the risking tools. These are instruments that reduce the perceived risk of nature investments for private investors, making it possible for them to invest at lower required returns. The main de-risking tools could be guarantees or first loss capital or concessional loans or government service contracts. We will examine how each of these could work in practice in later slides. So the fourth category is scaling tools. These are the mechanisms for reaching the scale that institutional investors require. Aggregation platforms for green bonds and landscape funds, for example. We would look at how municipalities can initiate or participate in these structures. And the fifth category is policy and enabling environment tools. These are potentially the most powerful, of course, but maybe somewhat underused tools in the municipal toolkit. They include adjusting local planning rules, introducing local biodiversity requirements, using public procurement to create demand for nature-based solutions, and then looking at national and global for the policy frameworks that nature finance needs to scale. So now we'll go through each of these categories in depth with some real examples that I've inserted after each of them that could maybe be helpful. So the first practical step for any municipality that wants to mobilize private capital for nature is to build, of course, a credible pipeline. This does sound obvious, but of course, in practice, is a step that might be skipped, or it might be that some municipalities would wait until they have a specific project that needs funding and then only start thinking about how to finance that project. By that point, it might be too late to redesign the project and make it bankable. Maybe a more effective approach is to develop a pipeline proactively in parallel with, let's say, your strategic planning and budget cycles, so that when investment opportunities do arise, you have investment-ready projects ready to present. Step one would be mapping. This is a starting point. The starting point is a systematic mapping, of course, of your territory. What nature assets exist within or adjacent to your jurisdiction? What are your legal obligations? Let's say Natura 2000 sites to manage, water bodies to restore, flood risk areas to address. What projects are already in your plans, maybe your pipeline at any stage of development? What is the rough scale of investment implied by each? This mapping exercise does not need to be expensive, maybe or complex. Maybe it can just begin with existing data and existing stuff, but it needs to be systematic and documented. Step two would be screening for finance potential. Of course, not every nature project can attract private finance. The screening step is about identifying which of the projects in your pipeline have, in principle, a viable revenue model or a de-risking pathway. For example, is there a beneficiary who could be charged for the ecosystem service? Is there a regulatory obligation that creates demand for the project? Could it be combined, for example, with other projects to reach investable scale that are more bankable on their own? So this screening is a quick qualitative assessment, of course, but not a detailed financial analysis, and its purpose is to identify maybe the top candidates for the next step. The step three in this process would be is project preparation for these priority projects. This is where you invest resources, ideally from a technical assistance facility rather than your core budget to develop the project to investment-ready standard. This means commissioning the feasibility study, maybe developing a financial model, or maybe structuring the legal vehicle and conducting the risk analysis. And last but not least, step 4 is building investor relationships before you need the money. So maybe many municipalities go to investors with a project and a funding gap and would expect the investor to make a quick decision. But of course, investors normally do not work that way. They do need time to understand the new sector, the new geography, and the new project structure. If one were to start presenting the pipeline to, let's say, development finance institutions or an impact fund or a national development bank, let's say 3 to 6 or to 9 months before you expect to need funding, it might make for a more sensible case study. So if you use that time to understand their requirements and adjust your project structure accordingly, because the relationships built in that preparation phase are often can be as important as the project itself. There's a fundamental paradox in nature finance. Of course, private investors do complain that they cannot find enough investable projects. Project developers complain that they cannot find investors. And then both complaints, of course, are true simultaneously, because the reason is that most projects are not investment ready. They exist as a good idea, a planning application, or an ecological assessment, but they have not been developed to the point where an investor can evaluate and commit to them. So what does investment ready mean in practice? It means that the project has gone through a structured preparation process that addresses all the questions an investor will ask. For example, is the site secured? Is the legal structure established? Has the revenue model been tested and documented? Has a credible financial model been built that shows projected cash flows under, let's say, different scenarios? Has the risk analysis been done and the risks allocated to appropriate parties? Or is there an idea how to allocate them? Is there a monitoring and verification plan for the nature outcomes? Has, let's say, a qualified project sponsor or a fund manager been identified? So, of course, all of this work would cost money and require specialist expertise, financial modeling, legal structuring, ecological assessment, the procurement design. For a typical nature project preparation might cost between, let's say, from tens of thousands of euros, maybe upwards to 500,000 euros, depending on project scope and size. This is, of course, real money, and it is money that is typically not covered by the project itself. So because the project does not yet have investors, this is the classic sort of chicken and egg problem. You need money to prepare the project for investors, but the investors only come after the project is prepared. So project preparation facilities exist precisely to break this cycle. These would be grant-funded or subsidized programs that provide the technical assistance and financial support needed to take a promising project idea through to the investment-ready stage. At the EU level, of course, we talked a couple of these yesterday. Instruments like the ELENA facility, the InvestEU Advisory Hub, or Jaspers, they do provide exactly this kind of support. And also, as we discussed, national development banks and regional development agencies could offer similar services. For the partners in this program, I guess the practical message is that if you have a nature project that you believe has the potential to attract private finance, but it's not yet investment ready, there are instruments available to help you get it there. You should probably not try to do it alone. You should not use your core operational budget for this work if dedicated facilities are available. And the fundamental point is that investing in project preparation could be one of the highest leverage uses of public money in nature finance. A well-structured project preparation investment of, say, 200,000 euros can enable maybe even a 10 million euro private investment. That is the mobilization ratio that is difficult to beat with any other public instrument. I have a case study here inserted. So it's not a story of a great project that succeeded, or it is more of a story about the gap that exists before any project can succeed, and what happens when you create a dedicated institution to fill it. So the Restoration Seed Capital Facility was established by the UNEP, which is the United Nations Environment Programme, with support from foundations and development banks, and its mandate is very narrow, but it's also critical. It is to fund the preparation phase of ecosystem restoration projects that have real potential to attract private capital eventually, but are not yet ready to do so. The key insight behind the Restoration Seed Capital Facility is that the main reason, of course, investable in principle nature projects fail to attract investment is not investor disinterest. It is that projects show up at investor conversations fundamentally unprepared. They do not have an ecological baseline, or they do not have a revenue model that has been tested against market realities or legal structure that can hold an investment. Without these things, there will not be maybe any serious investors who will engage, regardless of how important the conservation objective is. So the facility fills this gap by providing patient, risk-tolerant, and early-stage capital, which is a mix of grants and quasi-equity, specifically to fund project preparation for forest landscape restoration funds. For our partner municipalities, I guess the model's implication is that before you can attract any form of private or blended capital, you need to do the preparation work, the feasibility study, the baseline survey, the revenue model, and the governance structure, for example. Do not skip this step or treat it as overhead, because this preparation, as mentioned, is the highest leverage investment you can make. Without it, nothing that comes after is possible. So yeah, I think that is enough, because I think I have a couple of others later. Of course, the engineering mechanisms are there for, and hopefully straightforward to understand, and they're there for reference for the future. I would not necessarily go into details, but hopefully you can see the different financing instruments, how the financial flow works. And I think most of the case studies are illustrated this way, taken from the Climate Policy Initiative, one of their studies, and I've used some other studies as well for this webinar. So let's go one step deeper into the toolbox. So the revenue toolkit. Of course, revenue is the foundation of bankability, and the good news is that local governments have more revenue tools than they often realize. The challenge is not the lack of mechanism, but maybe the political will or the administrative capacity to design and implement them. The service contracts are perhaps the most straightforward revenue mechanism. The municipality, a utility, or a government agency could sign a long-term contract, typically 10 to 20 years, under which it pays the project operator to deliver a defined nature-based service. For the floodplain restoration project, this might be a contract with the municipality's flood management department. For a catchment restoration project, it might be a contract with the regional water utility. The key features are a defined service standard, a regular payment, and a term that is long enough to service the investment. and also mechanisms for performance monitoring and contract adjustment. So service contracts are familiar instruments. They are used routinely in waste management, for example, water supply, public transport, and their application to nature-based services is just a natural extension. Developer contributions are increasingly important revenue mechanisms in the European context. As EU member states begin to implement mandatory biodiversity impact assessment requirements, the principle that developers must compensate for biodiversity losses is gaining ground. So municipalities can go maybe one step further by requiring biodiversity net gain, which would be the net improvement in biodiversity as a condition of, let's say, planning permission, which could create demand for off-site nature restoration that project operators can supply for payment. Land value capture is a mechanism that is widely used for transport and urban infrastructure, but may be underused for nature. The principle is that public investment in green infrastructure, a park, a river restoration, or a green corridor increases property values in surrounding areas. Some of that increase could be captured through property taxes, development levies, or betterment charges, and recycled into investment. In cities with high development pressure, land value capture near high quality green infrastructure can generate maybe significant revenues. Then there are green tariffs and levies work by adding a small charge to existing utility bills, water, waste, electricity, that is ring-fenced, let's say, for nature investment. The principle is similar to how some water utilities already fund catchment management through a small element of the water tariff. The charge per household or per business is typically very small, maybe a few euros per year, but the aggregated costs across thousands of users, maybe it can generate meaningful revenue stream. Performance or outcome-based payments are maybe some of the more sophisticated revenue mechanisms, and maybe those that most align with investor expectations around accountability and measurability. Payment is tied not to activities, let's say planting trees, installing infrastructure, but to verified outcomes. A measured improvement, let's say in water quality, a confirmed increase in biodiversity units, let's say, or a documented reduction in flood peak flows. This requires, of course, a monitoring and verification system, but it also creates the clearest alignment of incentives and the most credible basis for a financial model. The critical point is that revenue maybe does not have to cover the full project costs to be useful. Even a revenue stream that covers, let's say, 50, 60% of the cost could be enough to attract some private co-investors for the remainder if the rest of the financing gap is covered by grants or concessional loans. This would be the logic of blended finance, on which I think there is a slide in the risking section. So crucially, local governments are almost always the actor who makes the revenue possible. You have the planning powers to impose developer contributions. You also have the contractual authority to sign service agreements, and you have the regulatory capacity, hopefully, to set fees and levies. In some cases, the private developers and investors cannot create these revenue streams, of course, on their own. They do depend on public actors to establish the legal and contractual basis. So I think before we break for a few minutes, I think because, again, same as yesterday, I forgot to mention that there's a planned couple of minutes of break during the session. It can be 5 or 10 we can discuss, but I think before that I had 2 case studies that are partially or fully relevant to the revenue mechanisms in the toolbox. So the first one is on the forest resilience bond that illustrates maybe the single and most important principle in nature finance, that bankability starts with identifying who benefits and making them pay. So the context here is the western part of the United States, which region faces catastrophic wildfire risk. Forests are overgrown, poorly managed, and increasingly likely to burn in ways that destroys watersheds, maybe contaminate water supplies, knock out power infrastructure, and generate enormous public costs. So the US Forest Service, of course, knows what needs to be done, thinning or prescribed burning, but does not have the money. And the contractors who do the physical work cannot be paid until federal agencies process their reimbursements, sometimes months later. So this creates the financing gap between when the work needs to happen and when the money arrives. Blue Forest, which is a nature finance specialist, answer was the Forest Resilience Bond. They identified that the people who benefit most from healthy projects are not just the public in general, they are specific identifiable entities. The Yuba Water Agency, which needs a healthy watersheds to provide clean water, hydropower utilities, which need water flow, a local insurance group, which faces wildfire claims, and then federal and state agencies which face fire suppression costs. Each of these beneficiaries have a quantified, documented financial interest in forest health. So Blue Forest partnered with the World Resources Institute, conducted the economic analysis that proved those numbers. There were 9 million USD in avoided costs, leading the Yuba Water Agency actually to commit 1.5 million US dollars in payments. So those committed contracted payments from beneficiaries become a revenue stream, and that revenue stream repays investors. There was a first pilot, which was called Yuba One, that raised $4 million in 2018 from a mix of concessional and commercial investors. Foundations like the Rockefeller and the Gordon and Betty Moore Foundations, they provided below market loans. And then there was an impact investor, Calvert Impact, and the regional insurance company, CSAA, that I mentioned, provided commercial capital. So the project did wind down in December 2023, with all capital return in line with expectations. And then there was another project, Yuba 2, that scaled to even higher, much higher. So it was USD 25 million. So the Forest Resilience Bond key innovation lies in addressing the finance gap for forest restoration work with investment enabled by beneficiaries' contributions. This model does work thanks to the quantification of forest restoration biophysical benefits that are used to attract funding from beneficiaries, including private sector actors. For our e-municipalities, maybe the translation would be directly, think about who benefits from the nature project you are planning, who pays less if the floodplain is restored, maybe your insurer, your downstream water company, your city's drainage budget. What is the economic value of that benefit? That could be your first sort of revenue conversation. The first resilience bond shows that if you can get one major beneficiary to sign a cost share agreement, maybe others could follow. And the revenue foundation need not be a market, it can also be a contract. Another case study here would be is the Blue Finance and the Turner Atoll marine protected areas, which is in Belize. And I wanted to use this to focus on two concepts. One is revenue stacking, and the other is the power of structuring place-based user fees. So this atoll is a marine ecosystem, which is one of the most biodiverse in the Caribbean region. It has official protected area status and provides enormous ecological, social, and economic benefits. Reef protection, the fish nursery habitat, there's a coastal storm buffering, and the major attraction for dive tourism as well. But like the vast majority of marine protected areas globally, had no reliable, sustainable financing, and management depended on intermittent government allocations or NGO grants. So Blue Finance, which is another nature finance specialist organization, developed a model based on a simple observation. The atoll has users and the users can pay. So commercial fishing operators benefit from healthy fish stocks, dive tourism operators depend on coral reef health, research institutions want access, and then recreational users visit. Every one of these user groups derives economic value from the marine protected area. The question is whether that value can be captured in a set of fees, charges, and licenses that collectively generate enough revenue to finance management and, crucially, a service alone. And the answer was yes, but only if you stack these revenues. So no single fee stream was large enough on its own. Fishing licenses were not enough. The dive fees alone were not enough, or the research permits alone would be just minimal. But if you stack them together, you can build a diversified revenue base that is both more resilient and more bankable. Blue Finance structured a blended finance facility for the Tunaf atoll, a grant capital from IUCN, Blue Natural Capital Financing Facility, which absorbed the first loss risk and funded the initial infrastructure investment. Concessional loans covered the medium risk section, or tranche, as they say in finance. The stacked user fee revenue serves both the loan repayment and ongoing management costs. So the total facility for the Belize pilot was approximately $1.2 million. And I think what makes this particularly interesting for municipalities was the replication potential, because Blue Finance has now applied the same structure template across 5 other marine protected areas in different countries and geographies. So the model is not a one-off, but it is an actual template for place-based conservation assets with user communities. So if your, let's say, municipality manages a Natura 2000 site, or a coastal zone, or a national park, or river valley with recreational users, or any natural heritage asset that people actively use and benefit from, you could ask yourself, okay, who uses this? What is it worth to them? Can a fee or charge structure be designed that generates some revenue? And this is the conversation which is a starting point for revenue stacking. So if you agree, maybe we could break here for 10 minutes, and I have, I think, a similar amount of slides for the second half of the presentation, and we'll run them through then with, I think, 2 or 3 other elements in the toolbox, and then the roadmap that we could discuss.
Yeah, for sure. Thank you, Matyas. So we will now take a 10-minute break. Please return at 11:08 CEST for the second half of session 2.
Thank you.
All right. Hello, everyone. It is almost 11:08. Welcome back, and we will now continue with the municipal toolbox.
Thank you. Hope you can hear me now. Myself. So yeah, so I will continue with tool number 3 in my list. So that would be de-risking instruments, which is the other half of the bankability equations. And for many nature projects, reducing perceived risk is more important than improving the revenue model. Even a project with a solid revenue model will fail to attract private capital if investors see the risk as unmanageable. De-risking tools work by changing the risk distribution in a project, shifting risk, let's say, from private investors to public actors, or reducing overall risk through contractual guarantees and financial protections. So guarantees are one of the most powerful and cost-effective de-risking tools available to public authorities. A guarantee is a contingent commitment. The guarantor, let's say the municipality, a national government, or a development bank, promises to pay investors a defined amount if the project generates less revenue, let's say, for example, than expected, or if a specific risk event occurs. The key advantage is that a guarantee does not necessarily cost money for the municipality in case the municipality provides it, unless it is called. If the project performs as expected, the guarantee would be not triggered, and the public authority would have mobilized private investment at zero or very low cost. When it is triggered, the cost, of course, is real, but if structured correctly, the probability of a call could be kept very low. So, of course, the difference is that if it's not a municipality, but it's a commercial institution that provides a guarantee that has cost, and that has to be structured into the financing. But it can still reduce risk. So first loss capital work differently. Rather than a contingent guarantee, the public or concessional investor actually puts money into the project, but in a subordinated position. If the project loses money, the first loss investor takes the first hit before any other private investors would be affected. This explicit risk absorption makes the senior risk holders, investors, much safer and enables private capital to participate at lower required returns. Development finance institutions, philanthropic foundations, and some EU routinely take first loss in blended structures. Concessional loans are provided at below market rates by, let's say, again, national development banks or philanthropic capital. By reducing the cost of debt in the financing structure, they improve the overall project economics and make the revenue model viable, even when revenues are modest. In the EU, some of the national development banks like KfW or BPI in France could be major providers of concessional finance for sustainable investment. So anchor investment by the municipality itself is another important de-risking signal. When a municipality or local government co-invests in a project, even a modest amount, it could send a clear signal to private investors that the public authority is committed to the project success and has skin in the game. And this dramatically improves investor confidence and is often a prerequisite for attracting private co-investment. De-risking through blended finance is one of the most powerful and widely used mechanisms, sustainable infrastructure and nature finance. And it is worth explaining again carefully, because it might be misunderstood. And hopefully this is maybe the most technical slide of all the presentation, and we wouldn't get more technical than this. So blended finance is not a single instrument. It is a principle, the strategic use of public or concessional capital to reduce the risk or improve the return profile for private investors, thereby enabling private capital to participate in investments it would not otherwise make. So the core logic is that private investors have a minimum required return and a maximum acceptable risk level. If a project's expected return is too low or its risk profile is too high to meet those thresholds, private investors will not invest. But if a public actor steps in and accepts a lower return or a higher risk position, absorbing the riskiest part of the investment, the remaining investment can become attractive to private capital. So to unpack what this means in practice, in let's say a blended finance structure, the total investment is divided into tranches, slices with different risk and return characteristics. The first loss tranche takes the first hit if the project underperforms. If the project generates less revenue than expected, the first loss investors lose their money first before any other investors are affected. This is the highest risk position, and in blended finance structures typically filled by a public grant or development finance institution, as mentioned, or a foundation. Because they accept the first loss, private investors in the more senior tranches would have much greater confidence that they will get their money back. So guarantees do work similarly. Again, a guarantee from a municipality or a development bank promises to compensate an investor if specified losses occur. It does not cost anything unless it is called for the municipality, but its existence fundamentally changed the risk profile of the investment and makes it possible for the private capital to participate. Its cost, if it's not provided by the municipality, so if it has a commercial angle, so if it's not provided for free, of course, it would have to be embedded in the structure. For local governments, I guess the key practical point is that you do not need large budgets to use blended finance, a guarantee backed by your balance sheet, a junior tranche, let's say funded by a philanthropic donor or a trust, a grant from a life project used as first loss capital if possible. These could be relatively modest public commitments that can unlock significantly larger volumes of private investment. The mobilization ratio is one concept that I discussed yesterday, which is the amount of private money mobilized per euro of public money committed. Could be 3-to-1, 5-to-1, or even 10-to-1 in well-structured blended transactions, even beyond that, of course, depending on the type of transaction or the scope of the project. So the key concept is that blended finance allows public money to be used as a strategic lever rather than a direct subsidy, multiplying its impact on the overall investment mobilized. Here in this slide, you can see multiple projects that could be pulled together to be financed, but it could be used, for example, for one particular project. So I have two case studies here that I thought to be relevant. This first one proves that maybe you do not need a mature liquid private capital market to start. What you need is governance, credibility, and a clear public commitment. So Quindale Lake, which is a reservoir that supplies drinking water to approximately 10 million people in Zhejiang province in China. The lake's water quality was under threat from agricultural runoff, fertilizers, pesticides, livestock waste flowing in from the surrounding watershed. And the local government had a legal obligation to protect that water supply, but traditional government-funded approaches were basically reaching their limits, so they were not really available. Then the Nature Conservancy, which had already been operating in China for many years before and had already established the first water fund in 2015, is partnered with the local government and the trust called Wangshan Trust to create the Quindale Lake Water Fund. And the key innovation was that the governance structure, a charity trust format that for the first time in China provided a credible legal and institutional vehicle through which private philanthropic actors could channel money into conservation projects. So to me, this sounds similar to the pond case study, I think, that we discussed before, which is also a similar trust format that can avoid capture by the way of how the board is structured. So this might sound technical, but it is quite important because in many EU member states there could be similar gaps. the legal and institutional infrastructure for conservation finance maybe does not yet exist in the right form, and that gap could be in itself a barrier. So the fund started with initial philanthropic grants, which amount to approximately $1.5 million USD from the Alibaba Foundation and the Minsheng Insurance Foundation. And the local government then co-invested in complementary infrastructure, water diversion projects, and wetlands. And the technical work in itself was provided by the Nature Conservancy. This would be a classic blended structure. There is public infrastructure, there is philanthropic capital, expert technical support, and it is coordinated through a governed vehicle. So what happened next is also quite interesting. The fund itself did not stay dependent on grants. It created a social enterprise called Huku that develops eco-friendly agricultural products, nature education, ecotourism, watershed, and then its revenues have grown ever since each year. And as the fund reputation grew, major corporations, including Starbucks and then Microsoft, began purchasing water credits, paying for the water conservation benefits they consume in their operations. So this corporate revenue stream is now serves as a growth engine. For EU municipalities, I guess there are two lessons. Maybe first, the governance and the legal structure. They are not just administrative details. They are what makes private capital feel safe enough to enter. And second is a well-structured fund backed by genuine public commitment that can progressively evolve from a grant-dependent model to a self-sustaining model. The other one, maybe this might be the longest one, but I thought to discuss this a little bit more elaborately. So this case study brings together several of the most important concepts that we discussed across both sessions. So outcome-linked returns, blended finance, off-take agreements by corporates, the MRV infrastructure, and the role of multilateral institutions in de-risking nature projects for mainstream investors. It also represents the largest outcome bond, which was ever issued by the World Bank, which makes it a landmark transaction and a useful reference point, maybe as the EU begins to develop its own nature credit and outcome bond frameworks. So to start with the problem that this transaction was designed to solve, the Amazon rainforest is, of course, one of the most important carbon sinks on the planet. But despite progress in reducing deforestation rates, large areas of degraded land remain that could, if reforested with native species, absorb significant quantities of carbon while restoring biodiversity and supporting local communities. So the ecological case for reforestation is quite overwhelming. The financial barrier, as we've seen throughout this webinar, was the question of who pays and how. So the project developer at the center of this transaction is called Mombak, which is a Brazilian company that acquires or establishes long-term partnerships with landowners of degraded land and reforest them with native tree species. And as the trees mature, they generate carbon removal units, or CRUs. So Mombak had a compelling project pipeline and a willing buyer in Microsoft. We signed the forward purchase agreement for up to 1.5 million carbon removal units at pre-agreed prices through 2032. So Microsoft also evaluates the projects for the carbon removal units integrity and also for environmental and social risk. This is the offtake agreement that makes the transaction, of course, bankable, because without the committed buyer at a known price, there would be no revenue model, and without a revenue model, there is no investment case. But even with Microsoft as off-taker, there would still be a financing gap. Mombak needed upfront capital to acquire the land, to plant trees and manage the project for years before the carbon revenues began to flow. And this is exactly the challenge we described when discussing the temporal mismatch between nature project costs and nature project revenues. And this is where the World Bank's outcome bond structure came in. So the World Bank issued a 200 million bond in USD, and investors received a guaranteed fixed coupon or interest on the bonds, which is below the rate on a below the rate of a standard World Bank bond, plus also a variable interest linked to the carbon removal unit production from the project. The difference between what investors would normally earn on another World Bank bond and what they actually earn is converted via a sort of an interest rate swap transaction with another bank. So basically, the present value of those future values were discounted and was transformed into present values money, which was close to USD 36 million. And this provided upfront project capital, which was disbursed to Momback in 11 scheduled milestone-linked installments. And these are contingent on the development company meeting agreed operational targets. And then the principal is fully guaranteed at maturity. And if any capital is not disbursed by the end of 2026, then that is returned to investors. So from an investor perspective, this structure offers something quite unusual because it has, of course, the World Bank's credit quality with principal protection and a modest but guaranteed fixed return, but also the possibility of a higher return if the reforestation project succeeds producing the carbon removal units. So in this case, 14 institutional investors across North America and Europe participated in financing or buying this bond or subscribing to the bond. So these are pension funds and asset managers who would not normally consider a direct investment in an Amazon reforestation project, but who can justify participation in a World Bank bond with an outcome-linked upside. So the lessons, I guess, for local governments and for our partners specifically, maybe there are four. First, the importance of the offtake agreement. So in this case, Microsoft's commitment to buy carbon removal units at pre-agreed prices was a very important factor in making this transaction viable. Before approaching any capital market structure, a nature project needs a credible buyer for its outputs. For e-municipalities, this could be, let's say, a corporate biodiversity credit buyer, a water utility paying for catchment services again, or a developer meeting the biodiversity net gain obligations. So identify the payer first. Second, a multilateral guarantor role is critical. World Bank's involvement did not just bring credibility, but it also brought the legal structure, the bond issuance capacity, and the credit quality that allowed fixed income investors to participate. And for municipalities, the equivalent roles would be played by the European Investment Bank and national development banks and the InvestEU guarantee mechanism. These institutions are not just lenders, but are enablers of more complex outcome in structures. So third, monitoring, reporting, verification is really the foundation of everything. The carbon removal units have to be measured, reported, and verified to a standard that Microsoft and institutional investors can rely on. The integrity of the outcome metric is what justifies the variable coupon. For nature projects in Europe, developing these robust MRV frameworks aligned with the EU CRCF framework and emerging biodiversity credit standards could be an essential preparatory step before any outcome-linked instrument can be structured. And the last, that this transaction is replicable in principle, if not maybe immediately. The outcome bond structure can be applied to a range of nature positive outcomes beyond carbon, including biodiversity units or water quality metrics or flood risk reduction. And the EU Nature Credits Roadmap, with a market launch anticipated in 2027, is laying the groundwork for these kind of transactions in the European context. So partners who begin developing measurable outcome frameworks, maybe now or in the near future, will be positioned to access these structures when the market opens. So now we get to scaling. We have already noted that most nature projects in Europe are small. A single wetland restoration, a city park upgrade, or a single farmer converting to nature-friendly practices. These projects might cost between, let's say, €500,000 to a few million each. And for most institutional investors, these are simply too small to engage with directly. The due diligence process for any investment would cost money. And for small investments, those costs are disproportionately high to the expected return or overall project cost. So pooling and aggregation solve this by bundling multiple projects under a single investment vehicle. Instead of, let's say, a single €2 million wetland project, you create a platform that holds 20 nature restoration projects across the region with a total investment value of, let's say, €40 million. You could also bundle nature projects in principle with other types of projects that may be less risky by nature. Now, the due diligence costs would be spread across many projects, and the investment could be large enough to attract institutional interest. The risk would be diversified across multiple projects and sites, which reduces the overall risk profile. And the governance and management structures of the platform, let's say the fund manager, the board, and the monitoring and reporting systems could be professionally designed to meet investor expectations. So several forms maybe of aggregation platforms are emerging in European nature finance. Landscape restoration funds could cover a defined geographic area and finance a portfolio of complementary nature projects within it. So combining, for example, wetland restoration, recurring buffer planting and sustainable agriculture, and the peatland revetting in a single watershed. Now, municipal green bonds or green infrastructure bonds could pool financing for multiple urban green infrastructure projects across a city or a group of municipalities. National or regional biodiversity credit platforms could aggregate verified biodiversity enhancement units from multiple sites and then sell them to corporate buyers seeking to meet their nature positive commitments. So green bonds are a particularly important scaling mechanism for municipalities because they are familiar, regulated, well understood investment instrument. A green bond would be simply a bond whose proceeds are contractually committed to a green or environmental project. The EU Green Bond Standard that was adopted in 2023 provides a rigorous framework for what qualifies as an EU Green Bond. Some municipalities can issue green bonds directly, and many do. I think one example would be Madrid in Spain, but there are some others as well who issue green bonds, and they use them to finance renewable energy, energy efficiency, and sustainable transport. So extending green bond proceeds to nature restoration and biodiversity could be a logical next step. And as I mentioned, some municipalities and regions might already be doing this. So the practical message for this section is that you do not have to design and manage a sophisticated platform yourself. You could participate in or contribute to regional or national platforms that have the professional capacity to manage the investment structures. Your role might be to contribute land or to provide a service contract or to offer a guarantee or simply to include your projects in the platform's pipeline. Even maybe a modest contribution to a well-designed regional platform can unlock private investment at a scale that would be impossible for a single municipality acting alone. The case study here that I found is an example for an aggregation platform, for example, is NATUREFIN, which is owned by Finnish municipalities, the state of Finland, and the public sector pension fund, I think, Kiva. NATUREFIN is one of the country's largest credit institution, I think, managing a balance sheet of over 50 billion euros. And the basic idea is that, of course, municipalities do not each go separately to the market. Instead, a specialized public sector finance institution pools the demand and raises capital at scale and lends onward to municipalities and related public entities. NATUREFIN, I think, also raises sustainable and green finance, which shows how public sector aggregation can connect local investment needs to wider capital markets. So why does this matter for nature finance? Because one of the big challenges for local governments, of course, not only project structure, but also access to affordable capital and the ability to finance a long-term infrastructure, and that projects can be too small in size to attract investor capital. So this is an example of a pooled model that could help solve both. And the lesson here is that, of course, for municipalities, do not always need to invent a bespoke investment vehicle from scratch, because if in your country or region, if there is a better answer, that is maybe to use or create an intermediary platform that aggregates municipal borrowing needs and maybe even standardizes approaches and provides a route through which green and nature-related investment can be financed more efficiently. And the fifth category, I think getting to the last category in the toolbox, is policy and enabling environment. Some actions, of course, do not require large budgets. They do require political will and the administrative capacity, the clear understanding of how the changes you make locally create the conditions that private investors do need. So planning and zoning powers are among the most important tools that local governments could have by embedding nature-based solution requirements and biodiversity standards into your local planning policies. You could create two effects. First, you can create a mandatory demand for off-site nature restoration for developers, which generates revenue streams for nature projects. Second, you create a policy certainty that investors need. They can see that the regulatory obligation exists, that it will endure, and that it creates predictable stream of demand. Then public procurement is another powerful tool that might rarely be used strategically for nature. When you procure flood management services, urban cooling solutions, water quality improvement, or coastal protection, you can specify that nature-based solutions are preferred or required. By putting a contract value behind nature-based services, even if it's a modest one, you could create a bankable revenue stream and a clear market signal that attracts private developers and investors. Local charges and levies, which mentioned before, can be introduced through municipal ordinances in many jurisdictions. A small green infrastructure contribution on development projects, a nature restoration element in the water tariff, or a green space maintenance levy on commercial property. These instruments are legal in most member states, and though the specific mechanisms can, of course, vary by the national legal framework. The important point to establish is that the legal basis is to establish the legal basis clearly and in a way that creates predictable long-term revenue stream, and it's not a one-off charge. Long-term commitments are simple but a powerful policy action. Publishing a multi-year nature finance strategy, committing in your budget documentation to fund nature services for the next 5-10 years or beyond, embedding nature investment targets in your statutory plans. These signals significantly reduce perceived policy risk for private investors. They answer the investor's fundamental question: will this policy still be in place in 10 or 15 years? So last but not least, advocacy through networks, of course, like Eurocities or Committee of the Regions or national municipal associations is maybe how local governments can influence the national and the policy frameworks that are still missing. The biodiversity credit market, ecosystem services valuation standards, national nature finance strategies that would create long-term revenue certainty. These might not happen without municipalities making the case. And of course, your voice matters at the European level as well. So using it strategically is itself a tool for mobilizing capital. I have, I think, maybe last case study here before we jump into the final sections of the webinar. So these are from the UK, so I wanted to show you two recent examples from the UK that demonstrate exactly maybe the success factors we just discussed, working in real municipal and regional contexts. So these are not aspirational or theoretical. They were funded through the UK's National Environment Investment Readiness Fund, which is a government program that explicitly designed to get nature finance projects investment ready. They are maybe the closest thing that the United Kingdom has to what maybe we're trying to help you build across the EU, or the NATUREFIN project tries to help you. The first is the Greater Manchester Environment Fund. This is a partnership between the Greater Manchester Combined Authority, which is a regional tier that sits above individual councils, and Finance Earth, which is a specialist nature finance advisory firm, with the Lancashire Wildlife Trust providing ecological expertise. They are restoring degraded lowland peat at a site in Salford, and Salford is close to Manchester, using a blended finance model where private investors are attracted by biodiversity net gain revenue and carbon income. The combined authority acts as the project anchor and policy guarantor. This gives investors the confidence that the regulatory environment supports the project. So this is precisely the role that EU municipalities can also play. The second example here is, so this is two examples in one case study, is the South Yorkshire Biodiversity Net Gain Market, where Sheffield and the Rotherham Wildlife Trust set up a biodiversity net gain marketplace. They cover 5 habitat sites across Sheffield City Council, then the Rotherham Metropolitan Borough Council, and the Peak District National Park Authority. And they sell biodiversity net gain units to developers who need to meet their statutory offset obligations. And they have built the consultancy arm as well, which is called Wildscapes, to generate additional revenue. And this model works because of England's, of course, mandatory 10% biodiversity net gain obligation in planning law. The lesson may be that if your country or region is implementing the nature restoration law targets, you might be able to create this kind of mandatory buyer market. So all these instruments, so the two different instruments, one is a special purpose vehicle, the other is a market platform. They all built in a combination of policy obligation, local authority leadership, embedded public-private capital. So now that we ended with the toolbox and the case studies, I would get into the summary section, I think, which is about kind of successful roadmap we created out of all these learnings. So drawing all the case studies on the broader body of evidence in nature finance, first I would summarize the common success factors. Firstly, a clear and contractually secured revenue stream. So every successful case we have examined has a revenue model that is documented, contracted, and backed by a credible counterparty. For example, the forest resilience bond worked because beneficiaries have signed cost share payment commitments, and the Widow Lake Fund worked in China because corporate water credits are purchased under formal agreements. The second is a strong policy anchor. So successful projects sit within a clear policy framework that creates and sustains demand for their outputs. In case of the Amazon outcome bond, it worked because sovereign governments have a nationally determined commitments to reduce deforestation. And also in the Quindale Lake Fund case, it worked because the local government had a legal duty to protect drinking water quality. So local and national policy commitment is not, of course, just a nice to have, but it can be a foundation of revenue certainty. Third is a credible project sponsor. In many successful cases, there is a good sponsor, a municipality or a specialized operator with the technical capacity and the governance structure, and in many cases, a financial stake in the project's success. This is the personal organization that investors are ultimately trusting when they commit capital. Fourth is the early proactive investor engagement, I guess. Successful projects and solutions engage potential investors well before the capital is needed, depending on context. So they use that time to understand investor requirements and refine the structure and build the trust that underpins the financial commitment. Fifth, robust ecological monitoring and verification. Successful projects invest in the monitoring and measurement infrastructure that produces the data investors and regulators need. Without credible ecological data, there's of course no credible credit or credible service delivery proof, and no sustainable investor relationship. Six, well-designed blended finance structure. Successful projects use public money strategically as first loss capital, as a guarantee or technical assistance to make the private investment case work without substituting public money for private money. And seventh is the realistic scale. Projects that have worked are either large enough in themselves to attract institutional interest or are part of an aggregation platform that achieves the necessary scale. So the NATUREFIN, for example, exists precisely because the small unprepared projects might be failing at the preparation stage. So scale and readiness must be built deliberately. So one of the important nuances in nature finance is different types of public authority have different tools, different capacities, and different leverage points. So I will briefly map this for the different partner types maybe represented in this program. Regional governments have the broadest geographic reach, and in many EU countries have significant competences in land use planning, water management, rural development, or environmental regulation. They could be well placed to anchor large landscape scale investment platforms that span multiple municipalities. They can advocate directly at national level for enabling policy frameworks. And they can also coordinate the EU structural fund programming in ways that create enabling conditions for private nature investment at scale. City and urban municipalities could have strong credit ratings, maybe the larger ones and bond market access, making the natural issuers of green bonds and urban nature and climate resilience. They could have planning powers also that can be used to introduce biodiversity requirements and green infrastructure standards for developers. They are large enough maybe to procure nature-based services directly through competitive tender, creating bankable service contracts. They also often have to have the institutional capacity to develop and manage complex financial structures. And then smaller municipalities typically do not have the scale or the institutional capacity to act alone in nature finance, but they have important roles, contributing their projects to aggregation platforms and landscape funds, or applying for technical assistance from EU or national facilities, using local planning and procurement powers to create the policy conditions for nature revenue models, maybe even at small scale, and then collective action through municipal associations, particularly important for smaller municipalities. Agencies and intermediary organizations can also play a critical role. They can provide the project preparation support, the financial structuring expertise, the investor matchmaking capacity that maybe individual municipalities lack. They can develop and manage aggregation platforms that pool projects from multiple municipalities. And of course, all partner types, across all partner types, one of the most important actions, collective advocacy that I just mentioned on the previous slide. So we are now the final part of the session, and just to try to make it as practical and actionable as possible without, of course, knowing all the regional and local contexts for the partner municipalities. What should municipalities theoretically, or what could they do about nature finance, specifically maybe in the next 12 to 24 months? If I were to propose a practical sequencing, first the priority is self-assessment, understanding your starting point, map your territory systematically. What nature assets do you have? What are your legal obligations? What is already in your pipeline? What is the rough investment implication of each? Second, in later months, maybe the priority is screening. Which of your pipeline projects have the potential to attract private finance? You could apply a filter. Is there a potential beneficiary who could pay for the ecosystem service? Is there a legal obligation that creates demand? Could the project be combined with others to reach investable scale? Three, is the priority is accessing technical assistance in step 3. For your, let's say, 2-3 priority projects, you could engage with the relevant EU and national technical assistance facilities, or your national developments, banks, advisory service, or a nearby philanthropic capital provider or trust that is close to you, or has your region in scope. Then the priority would be to develop the financial structure for each priority project. You could commission the full investment readiness package, revenue model, financial model, legal structure, monitoring and verification plan. This is the work that would turn a good project into a bankable instrument. And fifth, can begin investor engagement. After all this, approach development finance institutions, national development banks, or impact-focused funds, and sustainability mandated, maybe institutional investors even, with your prepared pipeline. In parallel, all of this, you could conduct a review of your local planning and procurement policies to identify quick wins, policy changes that you can make within your existing authority that will create revenue mechanisms, reduce investor risk, or signal long-term commitment. And then summary and next steps. I just want to summarize, and I see we're a little bit short on time. So we covered a great deal of ground in these 2 sessions. I will close with the 6 key messages left here. I will not go through them one by one because I think we only have 9 minutes from the official time. So I will just hand it back and maybe try to answer some of the questions you might have. Thank you. I can start maybe sharing now. Thank you.
Thank you so much, Matyas. So yes, we will now start with the Q&A segment. So please add some questions into the Q&A part of the Teams, and we will read the questions out loud so everyone can follow the discussion. Let's see. Just give it 1 second, maybe.
Of course.
We have participants typing in the chat, thinking of questions.
Hopefully I have preempted some of the questions that could have arisen, but of course, I don't have the full context for the municipalities, although I try to research a great deal of the 6 partners.
I guess we can start with question to roll things off. What do you think? Which municipal tool is usually the fastest to achieve or to activate? Would it be like the pipeline preparation or de-risking, scaling? What do you think?
Well, I think, yeah, so quick wins could be probably around procurement, planning, zoning, how, to look at how potential biodiversity or nature-related requirements could be inserted quickly, or let's say if there is a project that is already ongoing around or in the scope of the area that is pertaining to the municipality, and there are still room in the design, there could be a quick win there to implement some nature-related elements. I think one proactive action could also be really to, and maybe for small municipalities, they could do this jointly with other smaller partners, maybe even within the scope of this project. The different sized municipalities could be sort of a peer learning. Could some peer learning activities be created, but to invest in baseline capacity building, to understand where they are at in terms of the different nature metrics, and try to be familiar with the different frameworks that are emerging in monitoring and reporting and verification, and create a baseline, even to try to create a registry, so to speak, of projects with some metrics attached to them, so that can create a great, and even maybe make it open source, to open it up for even local, let's say, enterprises to participate, and facilitate them to participate in these registries with their projects, because these can serve all the foundations of what is emerging, I guess, in the form of the EU nature restoration law when it is going to be implemented, and the EU nature control, when it actually becomes more mature. These tools can go a long way, I guess, for proactively taking these steps for the future.
Thank you so much for the insightful answer. We have time for maybe one more question. We have one here from Helena. What type of organizations should the regional authorities reach out to broker these complex deals that include de-risking elements, partnerships with the private investors?
I think hopefully some examples during the presentation showed this. I think the first step would be to, let's say, to understand what's available in your region, in your country, to understand whether your local development bank, let's say the Hungarian Development, the Magyar Fejlesztési Bank in Hungary, or the Hellenic Development in Greece, have certain programs that you can use, or technical assistance facilities. For, let's say, in Finland, I don't know if I know it, because I think I read that there's been some very good progress in creating do no significant harm standards and biodiversity related mechanisms. How can that be fed into, for example, the NATUREFIN program? Look around which organizations, NGOs, or foundations are active in your area. They might already be close by, or a nearby region, and they might have your region in scope. I think the Pont example was maybe a good one for in Albania. So these kind of organizations, hopefully that's a good answer. Of course, it will always depend on the context, but try to shoot to as many institutions as possible. I think there is there's not much that you can lose, right? You can only potentially gain. Maybe you learn something, or you've seen something that you haven't seen before, an opportunity.
Thank you so much, Matyas. I believe it might be time to wrap things up. It is almost 12 o'clock. So on behalf of all the participants, I'd just like to thank you again for sharing your expertise, across both sessions. On behalf of the Sustainable Finance Research Center, Corvinus University of Budapest, and the NATUREFIN Partnership, thank you to all the participants for joining us. We also thank our partners from Hungary, Finland, Greece, Portugal, Spain, and Albania for their continued engagement. Follow-up materials, so this recording and the previous recording, will be shared after the webinar where applicable. And we look forward to continuing the conversation on financing biodiversity, ecosystem restoration, and nature-positive regional development. Thank you all so much again. Make sure to follow us on our social medias, and we will see you very soon. Thank you so much again, Matyas.
Thank you very much. Thanks for your engagement.